Okay, let's unpack this. In the vast and honestly often bewildering landscape of decentralized finance, DeFi, right? You've got platforms promising everything under the sun. Passive income, instant loans.
Yeah, it's a lot to sift through.
Exactly. So how do you navigate it all? Today, we're aiming to cut through some of that noise. We're doing a deep dive into one specific platform, Tectonic Finance, and its native token, TONIC.
And what's really remarkable here, I think, is Tectonic's ambition. They're trying to take these, complex traditional finance ideas and make them transparent, decentralized.
Right.
So for you, the listener, understanding this means getting a handle on a platform that's built for both, like the long-term crypto holders and the more active traders. It offers ways to earn passively, but also options for borrowing.
Okay, so that's the big picture.
Yeah.
And today, specifically, we're going to unpack Tectonic's core mechanics, right?
Yeah.
We'll get into the tech backbone. It's on the Cronos blockchain, uses smart contracts. We'll dig into that. We'll look at its unique features. Staking, sure, but also some innovative risk management tools they have. And crucially, security. How is it implemented?
Always key in DeFi.
Absolutely. Plus, we'll glance at their roadmap. They've got plans for something called leverage yield farming. Sounds intense.
High risk, high reward potential there.
Yeah, definitely. And finally, we'll tune into the community buzz. What are people really saying? The good, the bad, the bullish, the cautionary flags, all of it.
Getting the full picture.
Exactly. So ultimately, we want to help you think about what engaging with a platform like Tectonic actually means. All right, let's kick things off. Tectonic 101. So fundamentally, Tectonic Finance is a decentralized money market on the Cronos blockchain. Okay,
Yeah.
Simple enough. But what does decentralized money market actually mean in plain English for someone maybe new to this?
Yeah, good question. Think of it like a digital pool, an open financial pool where you can do two main things. You can lend out your crypto deposit and earn interest passively. Or you can borrow other cryptocurrencies using your own deposited crypto as collateral. The key word, like you said, is decentralized. It's non-custodial, meaning you keep control of your keys, your assets.
Right, not like a bank holding it for you.
Exactly. And it's algorithmic. Smart contracts automate the whole process, the lending, borrowing, interest rates. It's all coded and transparent. No bank manager deciding things behind closed doors. Your assets, your control, open rules.
So it's a pretty fundamental shift. Sounds really flexible too. If you're just HO dealing, as they say, holding long term, it's a way to potentially earn something on those assets without actively trading. But if you are a trader, you could borrow maybe for shorting or yield farming or just getting access to different crypto without selling what you already hold.
Precisely. It serves both needs.
Are there common misconceptions, like when people hear borrowing in DeFi, what do they sometimes get wrong?
Well, a big one is thinking it's like getting an unsecured personal loan from a bank. It's absolutely not. In DeFi lending like this, you're always over-collateralizing. You have to deposit more value in crypto than the amount you want to borrow. That's the safety net that keeps the whole system solvent.
Makes sense. Got it.
And what's really compelling, especially for users trying to gauge reliability, is that Tectonic isn't some brand new experimental idea cooked up yesterday. It's a fork of the Compound protocol.
Oh, right. Compound's well established.
Exactly. Battle-tested, heavily audited, proven in the market for years. So Tectonic inherits that core foundation, that security model, that functionality. It provides a really significant layer of, let's say, initial reliability. It's built on something known.
Okay, groundwork laid. Now, let's peek under the hood a bit. The engine driving Tectonic, the Cronos blockchain. Why Cronos? What's special about it for a DeFi platform like this?
Good question. So Cronos is what we call an EVM-compatible chain. EVM stands for Ethereum Virtual Machine.
Meaning it works well with Ethereum stuff.
Basically, yes. It makes it easier for developers to port applications over, and for users, it often means familiar wallet interactions. But the crucial part for DeFi is its consensus mechanism, proof of authority, or POA.
Okay, POA. What does that translate to for the user?
Speed and cost. POA is designed for high throughput and really fast transaction finality, and importantly, lower transaction fees compared to, say, Ethereum's mainnet historically.
Right.
For a DeFi platform where you might be doing multiple transactions, supplying, borrowing, repaying, staking, those fees add up. So fast and cheap is pretty vital.
Fast and cheap, yeah. It's definitely music to any crypto user's ears.
Yeah.
And underpinning all this activity are the smart contracts. Can you give us maybe a simple analogy? What does a smart contract do on Tectonic?
Sure. Think of a really sophisticated vending machine. You put your money in, your crypto deposit, you select what you want to borrow or lend, and the machine automatically executes the agreement and dispenses the product. the loan, or the interest earned. No human intervention needed for the core function.
Okay, I like that. Automated agreement.
Exactly. It's code. Meticulously written, self-executing digital contracts that handle the lending, the borrowing, the interest calculations. It ensures transparency because the rules are in the code for anyone to inspect, and it's impartial. And these contracts are also composable.
Composable, like Lego bricks.
That's a great way to put it. Financial Lego bricks. They're designed to easily connect or snap together with other DeFi protocols, so developers can build new, layered financial services on top, potentially offering you more options. Plus, they're typically open source for review and designed to be upgradable over time. This all contributes to that trustless idea you're trusting the audited code, not a person or company.
All right, we've got the basics, the foundation. Now, what makes Tectonic stand out? Let's dive into the core features, starting with the heart of the ecosystem, the TONIC token itself.
Right, the TONIC token, it's not just, a coin to trade. It's the native governance and utility token for the platform. And the supply is, well, it's huge. 500 trillion total supply.
Wow, 500 trillion. That's a lot of zeros.
It is. But a very significant chunk, over half, 50.9% actually, is specifically dedicated to community rewards and incentives. That's things like liquidity mining rewards, staking rewards.
So it's designed to encourage people to actually use the platform and hold the token.
Exactly. It's a deliberate strategy to bootstrap the ecosystem and reward active participation and long-term holding.
Okay, so if you're holding TONIC, how do you put it to work? Staking is usually the first thing people think of.
Yep, standard DeFi play. You can stake your TONIC tokens. By doing that, you earn passive yield. And that yield comes directly from a portion of the fees generated by borrowers on the platform.
So your earnings are tied to platform activity.
Correct. More borrowing activity generally means more fees, potentially leading to higher staking yields. There is a catch, though, a 10-day cooldown period if you want to unstake.
Ah, okay. Why the cooldown?
It's a mechanism to add stability. It discourages people from rapidly moving large amounts of TONIC in and out of staking based on short-term market fluctuations, which could cause price volatility.
Gotcha. Prevents knee-jerk reactions.
Sort of, yeah. But if you're really committed and looking for potentially higher rewards, they also offer something called maturity lock vaults.
Maturity lock vaults. Sounds serious.
Yeah, well, it requires more commitment. Here, you lock up your Tectonic for fixed periods anywhere from 6 months up to 48 months, so 4 years.
Wow, 4 years is a long time in crypto.
It absolutely is. The idea is the longer you lock, the higher the yield you can potentially earn. It's designed to reward those who are betting on the long-term success and growth of the Tectonic network. But obviously, you sacrifice liquidity. Your tokens are locked.
And is there a minimum to get into these vaults?
Yeah, you need at least 100 TONIC tokens. It's not a huge barrier, but it filters out, dust accounts and focuses on slightly more committed participants.
So longer commitment, potentially higher rewards, makes sense for incentive alignment. Okay, moving beyond Tectonic itself, how does Tectonic handle the actual assets people deposit, like USDC or wrapped to Bitcoin? And what about managing risk in these, let's face it, often volatile markets?
Great questions. That's where Atra tokens come into play. When you supply an asset, let's say you deposit USDC into Tectonic's liquidity pool, you receive a corresponding amount of TUSDC back into your wallet.
So TUSDC is like my receipt.
Exactly. It's your digital receipt representing your claim on the underlying USDC you deposited, plus the interest it's earning over time. These tokens actually increase in value relative to the underlying asset as interest accrues in the pool.
Ah, so the head token itself gains value.
Correct. It's a liquid, interest-bearing representation of your deposit. You can hold it or potentially use it in other DeFi protocols later. That's part of the composability we talked about. And when you want your original USDC back, you redeem your TUSDC.
Okay, that's clever. Now the scary part, liquidation. Lending platforms need a way to handle bad debt if collateral values drop. How does Tectonic manage this? And crucially, how do they warn users? Nobody wants a surprise liquidation.
Absolutely crucial. And yeah, definitely the scary part for borrowers. Tectonic has a standard liquidation mechanism. If the value of your deposited collateral falls below a certain threshold relative to the amount you've borrowed, this is called the collateral factor, then a portion of your collateral becomes eligible for liquidation.
Meaning someone else can buy it at a discount?
Essentially, yes. Liquidators step in, repay a portion of your debt, and receive a corresponding amount of your collateral at a slight discount as an incentive. This is vital to keep the protocol solvent and prevent it from accumulating bad debt.
Okay, necessary evil. But the warning, How do I know if I'm getting close?
This is where Tectonic has a neat user interface feature, the lava bar.
The lava bar. Sounds dramatic.
It's meant to be. It's a visual gauge on your user dashboard that shows your borrowing health, your proximity to the liquidation threshold. As your risk increases, the bar fills up and presumably gets redder, like lava.
Huh. Okay, so it's a clear visual warning. Danger zone.
Exactly. It's Tectonic's way of shouting, hey, your position is getting risky. You might want to add more collateral or repay some of your loan before you actually hit that liquidation point.
That lava bar is a great visual. But markets can move incredibly fast, right? If my lava bar suddenly spikes red during a flash crash,
Yeah.
what happens? What are my immediate options besides panic?
Right. Speed matters. That's where Tectonic Core comes in. Think of it as the protocol's brain, its risk management layer running constantly in the background.
Okay.
It processes every transaction request, supply, borrow, withdraw, and it's continuously calculating a dynamic risk score for your specific position, comparing potential hazards against your balances.
So it's actively monitoring my risk level.
Constantly. And to help you manage that oh no moment when the lava bar flares up, Tectonic offers several leverage management tools. These are designed for quick action.
Like what? What can I actually do right then?
Well, there's repay with collateral. This lets you use some of your deposited collateral to directly pay down your loan without needing to bring in external funds immediately.
Ah, okay, that's useful in a pinch.
Very. There's also collateral swap, which lets you quickly swap one type of collateral for another, maybe something less volatile if you think that'll stabilize your position. And of course, you can always add more collateral or repay parts of the loan with funds from your wallet.
And you mentioned shorting earlier.
Yes, for more advanced users, you can effectively short assets. You borrow an asset you expect to go down in price, sell it immediately, hope the price drops, then buy it back cheaper to repay the loan, pocketing the difference. Risky, obviously, but it's an option the platform enables.
Got it. And what assets can you actually use on Tectonic? Is it just TONIC?
Oh, no. It supports a range of major assets. You've got CRO, obviously, being on the Cronos chain, then wrapped WETH, wrapped BTC, WBTC, and several major stablecoins like USDC, USDT, DAI, and TUSD. Gives you decent flexibility for lending and borrowing strategies.
Okay, switching gears a bit, but it's absolutely critical. Security. In crypto, trust is everything, and security breaches are, well, they're devastating. How does Tectonic build that trust? How robust are its defenses?
Yeah, you're right. It's foundational. And Tectonic actually has a pretty strong story here, partly because of its origins. As we mentioned, it's a fork of Compound.
Right, which was audited by big names.
Exactly. Trail of Bits, Open Zeppelin, top-tier auditing firms reviewed Compound's code extensively. But Tectonic didn't just rely on that inherited security. They've gone through multiple independent external audits of their own code since launching.
Oh, they commissioned their own audits too.
Yes, multiple times. They've used reputable firms like Slowmist. They did audits in December 2021, March 2022, and April 2023. Also BlockSec in March and December of 2022. Plus, they get security support from the Cronos Labs team itself.
Wow, that's quite a few layers of review.
It is, and it's ongoing. For you as a potential user, seeing that repeated commitment to third-party validation is a significant positive signal in a space where, frankly, many projects skimp on audits. It shows they take security seriously.
Yeah, it definitely helps build confidence. What about the day-to-day? Beyond the big audits, what security measures are in place?
It's a multi-layered approach. You've got the technical stuff, advanced encryption protecting data both in transit and at rest, robust network security protocols, things like firewalls and intrusion detection systems monitoring traffic.
Standard but necessary.
Absolutely. And critically, there's continuous 247 monitoring of the platform for any anomalous or suspicious activity. The goal is proactive threat detection, not just reactive cleanup after something bad happens.
And zooming out a bit, what about regulation and compliance? That's becoming increasingly important.
Yeah, Tectonic is actively working to adhere to evolving crypto regulations and standard financial compliance, like anti-money laundering AML laws. Interestingly, their approach to custody services even got some legal validation back in July 2020 from the U.S. Office of the Comptroller of the Currency, the OCC.
Oh, really? What did the OCC say?
They issued a clarification, essentially stating that national banks could provide cryptocurrency custody services for customers. While Tectonic isn't a bank, having that kind of regulatory clarity helps legitimize the underlying services they offer, bridging the gap somewhat between DeFi and traditional finance expectations. It adds another layer of perceived legitimacy.
So it's a combination of strong, audited code, ongoing vigilance, and playing by the emerging regulatory rules. That sounds like a comprehensive approach. All right, so we've covered the present. Let's look to the future. A roadmap can tell you a lot about a project's ambition and direction. What's on the horizon for Tectonic, based on what we know as of, say, August 2025?
Absolutely. The roadmap is key, and Tectonic has some pretty significant milestones planned or in progress. A really big one is the governance module launch. This is targeted for Q4 2025.
Governance module. So like handing control over to the token holders.
Essentially, yes. It's the transition to becoming a decentralized autonomous organization, a DAO. Once this module is live, TONIC's token holders will be able to propose and vote on critical protocol decisions.
Like what kind of decisions?
Things like protocol upgrades, changes to the fee structures, which new assets should be added to the platform for lending and borrowing, basically steering the future direction of Tectonic.
That's a big step towards decentralization.
Yeah.
Was this always the plan?
It was. It was actually mentioned way back in the original 2021 white paper. Now, it has seen some delays in implementation, which, let's be honest, is pretty common in crypto development, especially with something as complex as on-chain governance.
It's understandable.
But launching it is a major milestone. It significantly increases the utility of the TONIC token, gives it a real purpose beyond just staking or speculation, and empowers the community.
Yeah.
Generally seen as a very bullish development for the token itself.
Okay, community control. What else is cooking? You mentioned something potentially riskier earlier.
Yes, leverage yield farming. This is anticipated for sometime in 2026. It's a planned upgrade designed to let users amplify their yield potential significantly by borrowing more. Basically, yes, you'd use your deposited assets as collateral to borrow more funds, which you then redeposit to earn yield on, effectively leveraging your position to chase higher returns.
Okay, that sounds like it could multiply gains, but also multiply losses.
Precisely. It's inherently a high-risk, high-reward strategy. It magnifies both upside and downside. For Tectonic to implement this safely, they need extremely robust liquidation mechanisms. One bad market swing could trigger cascading liquidations if not managed perfectly.
Is the platform ready for that kind of complexity?
Well, their current market cap, around $1.4 billion, suggests they have significant liquidity, which is a prerequisite for handling leveraged positions. But the timing is interesting. Right now, the broader crypto market sentiment measured by the Fear and Greed Index is sitting at neutral around 45.
Meaning people aren't feeling overly adventurous.
Exactly. There might be limited appetite for super complex, high-risk DeFi strategies at the moment. So while the tech might be ready in 2026, market conditions will play a huge role in its adoption.
That makes total sense. It's not just about can they build it, but will people use it responsibly? What's your number one piece of advice for someone tempted by leverage yield farming when it arrives?
Know what you're getting into. Understand that amplified rewards means amplified risk, full stop. Liquidation can happen much, much faster. Monitor your positions like a hawk. Understand the liquidation thresholds inside out, and never leverage more capital than you can truly afford to lose entirely. It's not for the faint of heart or the underinformed.
Solid advice. Anything else on the roadmap? Expansion plans.
Yes, they're also looking at EVM chain expansion. There's no from date on this yet, but the goal is clear. Expand Tectonic beyond just the Cronos chain to operate on other EVM-compatible blockchains, think Polygon, Avalanche, maybe others.
Multi-chain. That could be huge.
Potentially massive. It would allow Tectonic to tap into the liquidity and user bases of those other ecosystems. We're talking potentially accessing a share of like $13.9 billion in total value locked, reported across various chains. It's a huge growth vector.
But challenging, I imagine. Competition.
For sure. Technical integration takes work, and they'd be going head-to-head with established lending protocols on those chains, like a Cave or Compound itself. Execution is key. And we should also quickly mention the ongoing development of their insurance fund.
Insurance fund. How does that work?
It's designed as another safety net. Tectonic allocates 10% of the interest paid by borrowers into this separate fund. The idea is that this pool of capital could potentially be used to cover losses in the event of unforeseen issues, like a smart contract exploit or a shortfall event. It adds another layer of protocol resilience.
Okay, building cushions. And one more thing, token burning. Is that something Tectonic is considering? How would that work?
Token burning is often discussed in the context of TONIC's large supply. The idea is to permanently remove a certain amount of TONIC tokens from circulation, perhaps by using a portion of platform fees to buy back and burn tokens.
And the goal is to reduce supply, making the remaining tokens more scarce.
That's the theory. If demand for TONIC stays constant or increases due to staking, governance, new features, while the supply decreases through burning, it creates deflationary pressure. In principle, this could lead to price appreciation for TONIC over the long term, but it's a delicate balance. The burn rate needs to be significant enough to counteract inflation from rewards, and demand needs to be sustained.
All right, we've covered the tech, the features, security, the future plans, but crypto isn't just code and roadmaps. The community vibe, the sentiment on the ground that can be just as important, right?
Yeah.
So what's the buzz? What are people actually saying about Tectonic and TONIC out there?
Yeah, this is where you get the real pulse, the human element. And looking at the sentiment around August 2025, it's pretty mixed, actually. There's definitely a bullish contingent fueled by recent activity, but there are also some loud, persistent, cautionary voices you absolutely need to hear.
Okay, let's start with the bulls. What's got people excited? What are the positive signals?
Well, you see the price action driving a lot of it. We've seen tweets from accounts like @CryptoGuruMax getting really hyped about, quote, 75% surge in 24-hour.
Wow, 75% is a big move.
Huge. And they're talking about whale accumulation theories, seeing big buys and charts screaming bullish divergence. That kind of momentum definitely gets attention and feeds on itself.
It sure does. What else?
Then there's the platform growth itself. @DeFi tweeted about Tectonic's total value locked the TVL crossing $50 million, noting it was the highest since June 2025.
So real money flowing in.
Exactly. And she specifically credited yield farmers chasing 12% APY. That astronomical yield, whether sustainable or not, is clearly attracting capital.
12,000% ATY. Okay, we need to talk about that later, but that's definitely an attention grabber.
Oh, absolutely. And then you have the rumor mill at Blockchain Bro speculating about a potential TONIC partnering with the top 5 DEX, suggesting it could 10x borrowing demand. Pure speculation, maybe, but it fuels hope.
Right, partnerships are always a big catalyst.
And finally, you just have the general retail enthusiasm, the meme culture. You know, at Crypto Memes For You posting TONIC to the moon gifs. It might seem silly, but it shows broader awareness and retail interest, which can impact price in the short term.
Okay, so price pumps, TVL growth, juicy APYs, partnership rumors, and meme magic. That's a potent mix for bullishness. But that 12,000% APY, that sounds alarms for me. What's the other side? What are the bears or the cautious observers saying?
And that's the crucial counterbalance. That insane APY is exactly where the skepticism starts. You have analysts like at Bearish Crypto calling it, and I quote, classic Deegan bait.
Deegan bait, as in attracting risk-loving gamblers.
Pretty much. Their warning is stark. When rewards drop and they will prepare for mass exits and price collapse, they're highlighting the extreme unsustainability of those yields. They're often fueled by temporary high token emissions, not fundamental value accrual. When the emissions taper off, the yield disappears, and so does the hot money chasing it.
So the fear is the yield is artificial and temporary, leading to a crash.
That's a major concern. And it's not just recent skepticism. If you dig back into older discussions, like on Reddit from maybe 4 years ago, you find historical complaints. Someone called it the buggiest app on Cronos. Back then, though, to be fair, that specific issue was reportedly fixed with a technical adjustment, switching an RPC node.
Okay, so maybe growing pains. What else historically?
More fundamentally, users like Fordell77 and Interesting Pizza 70 raised concerns about the tokenomics even back then. Comments like, the amount of tokens to be released has killed the project, and concluding that TONIC wasn't a great long-term hold. They were worried that the massive supply and ongoing emissions would constantly dilute the value, preventing significant price appreciation regardless of platform success.
So long-standing worries about inflation and token value suppression, coupled with current fears about unsustainable yields.
Exactly. It paints a picture of significant potential, driven by high rewards and platform activity, but shadowed by very real historical and current concerns about long-term token value sustainability and the risks inherent in chasing those astronomical yields. It's a complex balance of opportunity and risk.
Wow. Okay, so we've really journeyed deep into tectonic finance today. We've looked at the core ideas, the lending, the borrowing. We explored the Cronos architecture, the smart contracts under the hood. We dug into the specific feature staking, those maturity lock, fault, D tokens, the lava bar.
The whole sweep.
We covered the layers of security, the audits, the compliance efforts. We looked ahead at that ambitious roadmap with decentralized governance and that high-stakes leverage yield farming. And crucially, we just heard the community pulse the bullish excitement, and those very important cautionary flags around Tectonic.
Yeah, I think this deep dive really shows Tectonic as, a serious contender in the DeFi lending space. They're building on a proven foundation. They're getting audited. They're innovating with features like leverage farming, even if it's risky. And they're moving towards community control with the DAO.
Right.
For you, the listener, it presents these really interesting, innovative ways to interact with your crypto. Passive income through supplying assets, strategic borrowing.
Yeah.
It's powerful stuff. But like anything on the cutting edge of finance and tech, understanding the risks is just non-negotiable.
Especially those yields.
Especially the sustainability of those incredibly high yields, yeah. And just the general volatility of the crypto market that underlies everything. That risk assessment has to be paramount before you even think about clicking a button.
Absolutely. It's a powerful, complex ecosystem they've built. And it leaves us with a final thought to chew on, really. In this space that moves so fast, where these crazy APYs and promises of instant finance grab all the headlines, how do platforms like Tectonic actually strike that balance?
The balancing act.
Yeah. How do they attract users, keep growing, offer compelling returns, while also building something stable, resilient, something that can weather the inevitable crypto storms, and at the end of the day, keep your assets safe? Finding that equilibrium between aggressive growth and long-term security, that's maybe the central challenge for Tectonic, and really for all of DeFi. Something to definitely ponder as you continue your own journey exploring this space.